I'm going to admit I don't know a ton about this fellow, but his name is Scott Stabile. And there's a quote that I read that I really like. And he says, after so many years of struggling to keep up with you, I finally realized that we weren't even running the same race. And he was talking about people, but this applies to us as investors too. The realization that you and other people have very different paths, very different goals, very different timelines. You were never actually supposed to compete with them in the first place. So let me ask you a question. Why do you compare your personal rate of return to an index? What does the S&P 500 or the TSX Composite or any other index for that matter have to do with your actual life? The truth is probably not much at all. But we have been conditioned that we're supposed to measure our investment performance against these benchmarks. If the market's up 10% and you're only up 7%, the natural reaction to that is that I'm falling behind. But here's the thing. The index was not built for you. It doesn't know about you. It doesn't care about you, your cash flow, your risk tolerance, or your investment goals. It is just a bundle of companies that have been thrown together that change from time to time. If a company is doing poorly, they toss it out. A different company has done really well, they're going to add it to the index. And yet, investors love comparing themselves to these indices. And you're going to hear people all the time talking about how they, beat the S&P last year, or they beat the NASDAQ. Or the flip side, they're feeling frustrated because they lag behind these indices. The financial news networks, of course, they do everything in their power to reinforce this mindset. And they plaster the index returns across the screen every single day. That's the first thing you see when the market's open. That's the last thing you see when the market closes. And this creates an illusion that the only scorecard that matters is how close your own performance lines up with the market. But I'm going to urge you to take a step back here and think about what that does to investors. When you compare yourself to an index, it can lead to two very dangerous outcomes. First of all, it can push you into very unnecessary risk. As an example, if the market is up 15%, you're only up 9%. There is a temptation then to shift into riskier assets just to keep pace. But then suddenly what you're doing is you're abandoning your carefully planned asset allocation because you want to keep up with the Joneses, except in this case, the Joneses are 500 companies that you don't even own, perhaps. Now, if I'm going to look at 2021 as an example, and the S&P 500 that year was up nearly 27%, and that is a good year to be sure. You can also see how the other major North American indices did here as well. There were tons of chatter. Everyone was making a bunch of money. But I just want to take a step back again and say, imagine that you're retired and you're living off your portfolio. So you see these strong returns and you thought you better get in on the game because, again, you're falling behind. Now, if you had tried to chase that kind of return by just putting your money into high growth stocks that had done so well in 2021, you could have risked blowing up your entire portfolio plan just when the market corrected the very next year. That same S&P 500 was down 20% in 2022. The NASDAQ down over 33%. Now, if we look at that 2-year period, the S&P 500 was up slightly, 2.22%. The NASDAQ was down 15.12. You can see there how the TSX fared quite well, up 18% over the 2-year time period. The second thing that chasing indices does is that it distracts you from the only thing that really matters to you is whether you are on track to hit your own goals. Again, the return of the various indices may be irrelevant to your goals. I agree that if you beat the index, kind of bragging rights, it feels good in the short term. But I got to ask, what kind of victory is that if it screws up the plan that you have put in place that's meant to carry you through the next, 2, 3, 4 decades? I urge you to think about that. So what is the alternative, you ask? Well, instead of asking, how did I compare to the S&P 500? Ask, am I on track to meet my financial targets? If your goal is to retire at 62, let's say with $5,000 a month in after-tax income, then that is your benchmark. And if your plan, based on your assets today, requires, I'm going to say, a 6% annual growth rate, and you're getting that, then you're winning. Even if the S&P 500 does 12% or 26% that year, because your benchmark is not the market. It isn't your neighbor. Your benchmark isn't the guy on BNN or on Squawk Box. It is your own financial life. You, your spouse, your children. This is your family's security that you're talking about here. Now, I do want to share a short personal story. And a number of years ago now, I ran a half marathon in Phoenix, Arizona. And it was my first half. And I set a personal goal of finishing in just over 2 hours. I thought that was a fairly respectable number for my first half marathon. And as I was finishing the race, I was in our lane, the half marathon. The full marathon finish lane was in the lane just to the left here. And the people who had started at the exact same time as I did, but 13 miles behind, they were just cruising past me, the other people I was running with, and they were providing us with encouragement to get to the finish line. So we were finishing at roughly the same time. And the point here is that those elite runners, they were also targeting what? About a 2-hour-ish finish. So we both hit our goals, but those goals were very, very different, right? We both hit our personal goals. So you could say that in both cases, we succeeded. But if I had compared myself to those elite runners who trained full-time all the time, if I had tried to keep up with them, I would have failed. I would have hit a wall very, very early. I would have stopped running, I'm sure. So if I had compared myself to them, a different strategy altogether, then I would have felt that I failed, I guess. So you compare yourself to your own standard. Now, another way to think about this is also comparing yourself to the pros can be very discouraging. I'm back to the money analogy here. It can actually have a very strong negative effect on you if you are comparing yourself to the professionals. And we think about it, our competitors, if you're looking at it that way out here, the pros, these are massive institutional investors. They have near infinite resources. They have teams of analysts that they're working with, and they place their trades like literally in microseconds. So if we expect to keep pace with them, while we're also holding a job, maybe living your life, occasionally trying to get some sleep in, it's just unrealistic to compare. It's also completely unnecessary to do that. Now, I do know that some people are going to push back on me here. If they're even still watching this video, they may have tuned out by now. But there is a contingent that is going to say, if I'm paying a fund manager, shouldn't I expect them to beat the index? And I do say that that is a fair question. Historically, that's how we've worked, that we compare the fund managers, the money managers, to the benchmark that do exist. Institutions, professionals, they do need a yardstick to compare whether a given strategy is worth its fees. If it's an actively managed fund and it's lagging behind the S&P 500, to use that example year after year, then yeah, maybe investors in that fund aren't getting good value. But there is a distinction here, and that logic makes sense when you're evaluating a fund manager. It doesn't make sense, though, when you're evaluating your own personal financial journey. Your plans, they have variables, of course, that the S&P 500 doesn't. Things like, when do you want to retire? Timing, that is a big one. Whether you're sending your kids to university, are they 5 today? Are they 17? How comfortable are you with volatility? Or whether you want to leave money behind for a family member. There is not an index in the world that reflects those personal factors, which is why using one of them as a scorecard can be probably pretty misleading. Quick example here. Imagine you have two investors. I'm going to make up some names here. I'm going to call them Brandon and Marc. Brandon, 30 years old, he's investing for the long term, has a high tolerance for risk. Marc, on the other hand, 63 years old, retired, and living off investment income. In 2021, both Brandon and Marc see that the S&P 500 that we just looked at returned that 27%. So Brandon looks at his portfolio. He says, I'm up 20% on the year, so he's going to feel disappointed by that. He underperformed the index, right? Marc looks at his portfolio, which was up 12% on the year, and he feels the same way. Again, he's missed at beating the index. But here is the reality that we have to frame this in. Brandon, the 30-year-old, he might still be perfectly on track to hit his long-term retirement target. And Marc's 12% return, that could be exactly what he needed to keep his own plan sustainable without taking on too much risk. Both Brandon and Marc technically underperformed the index, but both are succeeding at the only benchmark that really matters to them, and that is their own personal benchmark. So instead of asking, am I beating the market? A better set of questions is, am I saving enough to meet my future needs? Am I taking an appropriate level of risk for my situation? Am I staying disciplined through the ups and downs? And if the answer to those questions is yes, then I would say you're probably in good shape. You're going to hear people on CNBC reminding you that the Dow just hit another all-time high, but you're going to be okay with that because you're meeting your own goals. I do say that indices should be informative, but they shouldn't dictate your own sense of progress. They're more a sort of background noise, but they're not your own personal main story. Now, I'm going to go a little bit off the money topic here and a little public service announcement, I would say. I would hope that this video, if you're still listening at this point, would be more than just an investing lesson. I do believe that this applies more broadly to how we measure success in general. So whether I think back to my race in Phoenix, fitness, career, your investment portfolio, comparing yourself to other people will often lead to frustrations, and it often leads to bad decisions, which in all of these cases can have pretty devastating effects. I'm just going to urge you to find your own success on your own terms. That will probably bring out more sustainable outcomes. So I'm just going to finish by saying, next time you see those charts on the screens, flashing all the numbers, remember that your portfolio isn't or shouldn't perhaps be built to beat an index. It is built to fund your life. So forget about the index. Your life is the benchmark that you should be targeting for. I do genuinely want to know what you think. What does work for you? Do you compare yourself to an index? What index is that? Or do you have a more personal measure? I would love to hear your thoughts in the comments. As always, I say thank you so much for watching, and we'll see you in the next video.